What's going on, guys? It's Hakeem here. So Amazon just reported their Q3 earnings, and you can see that in the after hours they are down 4%. And I suspect that when the market opens, they're probably going to fall even further. Now, by the time that this video is out, we'll know the answer to that. My suspicion is that they're going to fall below $3,200 and maybe even slightly lower than that. Who knows, of course, but we'll see. Anyway, we'll get into why they fell. So this article by CNBC reads, Amazon badly misses on earnings and revenue and gives disappointing fourth quarter guidance. So you can see here that at the very high level, earnings were only $6.12 per share compared with $8.92 per share, which were expected by analysts. So that is a huge miss. And then we come on to revenue, and revenue was $111 billion compared with $111.6 billion, which was expected by analysts. So there's not a huge miss on the revenue, but the miss on the earnings is absolutely massive. So we're going to dig into why exactly that was, and is it a concern for shareholders? But just before we dive into the earnings, about a month ago, I released a video on Amazon's financials where I said that their financials are actually really deceiving, and I don't think that a lot of people actually understand what is going on. And just to summarize what I went over on that video, I explained that although their revenue growth is really good and they score very highly compared to the other big tech companies, so you can see here that on a compounded annual growth rate, it was 27%, and that ranked them second. Their EBITDA margins were actually the lowest of the big five tech. Their unlevered free cash flow margins were also lowest of the big five. And their enterprise value to EBITDA was fourth in terms of how expensive the company was. So sort of on the face of it, they look like a terrible company to invest in, but when you actually dig into what this actually means and why these figures are the way that they are, you start to understand that all is not what it seems. So effectively, I went on to explain that Amazon is investing or reinvesting into its business like no other company, right? So their investments into the business is far superior to the other big tech. And effectively, I came up with a few different metrics which really demonstrated this. So CapEx against or versus cash from operations. So in other words, how much are they investing in capital expenditures? For Amazon was 51%. You can see that Facebook was 36%, Microsoft 26%, Google 34%, and Apple just 13%. So effectively, we're showing there that Amazon are reinvesting into their business at a greater rate relative to the amount of cash that they are producing. And then similarly for costs on research and development, so coming up with new products, Amazon's was 86% versus their sort of profits or their cash profits being EBITDA. You compare that with Facebook, which was 40%, Microsoft 30%, Google 50%, and Apple 19%. And then effectively there's a chart here which actually demonstrates that Amazon's capital expenditures are not slowing down. In fact, it's much the opposite. They're actually speeding up at an incredible rate. And you compare that with the other big tech companies which have pretty much plateaued. All of this is to say that we're expecting that Amazon's growth is going to continue at a very high rate compared to the other companies. Anyway, that's not what this video is about. We'll get into their Q3 earnings. So we open up the presentation for the Q3 earnings, and on the very first slide, free cash flow, which is great to see as the first slide because in my opinion, and in many investors' opinions, it is the most important metric to valuing any company. Anyway, free cash flow, trailing 12 months, is down 91% year over year. Now, what a way to open your investor presentation, right? Now, most companies try and start with the good news first and then put the bad news in the back. Amazon don't think like that, right? So Amazon straight up are telling you, look, our free cash flows have actually declined 91% year over year. People are going to look at that and they are going to be very concerned. So Q3 2020 was $30 billion, and in Q3 2021, $2.5 billion. Absolutely significant increase, but let's actually look into what that is. So just in case you are unaware, free cash flow is cash from operations less your capital expenditures. And when we actually look at what their cash from operations were, we can see that operating cash flow only decreased by 1% year over year. In other words, what's the difference there then? Well, we're seeing a huge amount of capital investment, which means that their free cash flow has actually declined significantly. Their cash from operations hasn't been impacted, but effectively they are reinvesting in the business at a significant rate, which has meant that their free cash flow has decreased by 91%, but their cash from operations has actually remained absolutely stable. So it's not all bad. Even still, we would hope for some growth in their cash from operations, but it's certainly not a decline of 91%. So, okay, we understand that, and actually what looked like a red flag initially isn't one after all. And then you can see here a one-liner, long-term goal, optimize free cash flows. Well, what does that really mean? It means that eventually they want to get to the point where they are maximizing or optimizing their free cash flows. In other words, not having to spend or not having to input so much money into capital expenditures, which will mean a greater amount of free cash flow to the business, which they can then decide to do with what they want, whether that is pay dividends or buy back shares. Either way, it will be a return to the shareholder. And then we can see here that shares outstanding have actually remained completely stable, which is good to see, right? So they're not diluting their shareholders. And I say completely stable, right? So they have increased by 5 million or 1%, right? So a 1% increase in their shares over a year is not such a bad thing, right? Effectively, all this is showing is that they aren't having to issue new shares and dilute current shareholders in order to fund the operations and fund the growth of the business. So that's a good sign to see. Shares have stabilized and they've pretty much been this way for quite a while now. It also could be an indication that management don't think that the business is overvalued at the current price. If it was overvalued, then management would be incentivized to at least consider issuing new shares and getting that money in order to fund the growth of the business. But they aren't doing that. They're happy to use the cash that they're generating from their operations to do that instead. So net sales for the quarter grew by 15%, which is slightly lower, as we saw earlier, than what analysts were expecting, but not by a significant amount. And also, so we went from $96 billion in Q3 2020 to $111 billion in Q3 2021. What you will notice is that Q4 2020 actually saw the greatest amount of revenue. And that's because Amazon is, to a small extent, a seasonal business, right? So in Q4, they start to ramp up their production due to, so we've got, for example, Black Friday, and then they also have the Christmas period, right? So they tend to sell slightly more in Q4, which is why, which we'll see later on, we're expecting revenues of $130 to $140 billion for Q4 2021. And then when we look at net sales on a trailing 12 months basis, we can see that it's actually up 32% year over year, which is pretty good. So Q3 2020, the trailing 12 months revenue was $350 billion. And at Q3 2021, it's $460 billion. And I think when we get to Q4 2021, we're expecting that figure to be around $480 billion. So we're almost at a $500 billion revenue company per year, which is sensational and absolutely fantastic numbers. And it really is just a matter of time before Amazon takes over, I believe, Walmart as the #1 revenue generating company in the world, right? So I think Walmart's is around $570 billion. I think give it a couple of years and Amazon will have overtaken those and be the leader in terms of revenue as a business. So that is obviously good news. When we come on to operating income, however, it is not good news, right? So we can see here that operating income is down 22% year over year. So in Q3 2020 was 6.2 billion and Q3 2021 is $4.9 billion. So from this slide alone, we can't understand what is going on and why that is. So we'll have a sort of a deeper look at the financials in a moment. But going on to net income as well, we can see that net income was actually down 50% year over year. So $6.3 billion down to $3.1 billion. Again, not a good sign at all. So we'll have a look into the financials at a deeper level to understand what is actually going on here. Just before we get onto that though, I want us to take a look at the segment results for Amazon Web Services. Now, Amazon Web Services gets a lot of attention and a lot of investors pay attention to it, and for good reason, right? So net sales for Amazon Web Services is up 39% year over year. So it's growing at a substantially faster rate than the rest of the business. So that was $16 billion in Q3 2021, compared with $11.6 billion a year ago. The most impressive part for me though is the income, right? So the profit that it actually generates. So that is up 38% year over year, which is largely in line with revenue growth. But when we actually look at what those figures were, $4.8 billion of profit on $16 billion of revenue. So that's an operating margin of around 30%, which is substantially higher than the operating margin for the rest of the business. So that's why this gets so much attention and people prefer the Amazon Web Services segment compared to the more consumer side of their business. Anyway, so that is a trailing 12 months revenue of $57 billion, right? So if we were to try and consider Amazon Web Services as a standalone business, what value would we try and attribute to that? So $57 billion in revenue, and it's growing at around 40% year over year, and it has operating margins of around 30% as well. So if we were to compare it to some of the other sort of companies within this segment, in this space, what kind of valuation would we attribute to it? So what I've done is I've had a look at Salesforce and I've had a look at Twilio. So we'll take each of these companies in turn. So both of these companies are cloud computing companies in a similar sort of space to which Amazon Web Services operates in. Luckily for us, because they are standalone companies, we can see what kind of valuations the market is actually attributing to these companies, and then we can try and apply that to Amazon Web Services to see how much that segment of the business should be valued. Anyway, right, so we can see here that for Salesforce, it's growing at revenues, or sorry, it's growing its revenues at around 25% on a compounded annual growth rate. So it's growing at a slower pace than Amazon Web Services. Not only that, its revenues are actually about half. In fact, their revenues are actually less than half. They're more like a third of what we see for Amazon Web Services. So they are growing at a lower rate and they are a smaller business. Now, what kind of valuation do you get from that? So if we look at the enterprise value to revenue for Salesforce, over the last 5 years, right, it has a mean of around 9, okay? If we look at 3 years, it's slightly higher, it's closer to 10. Anyway, so that's Salesforce. So remember those figures, right, around 9 or 10. Now, if we move over to Twilio, now Twilio is actually growing at similar pace to Amazon Web Services. So on a compounded annual growth rate, it's around 53% over the last sort of 6 or 7 years, or the last sort of 5 or 6 years, and then 1 or 2 years going forward. But its revenues are so much smaller, right? So we can see revenues here around $2.8 billion expected for 2021. So it's about, what is that, a 20th of Amazon Web Services. So it's much smaller. Anyway, the valuation that is applied to Twilio on an enterprise value to revenue basis, an average of 17, right? If we look over the last 3 years, it was an average of 23. So look, I mean, somewhere between 9 and 17 would be prudent, in my opinion, to apply to Amazon Web Services. I think that, if I'm being honest, I think that if Amazon Web Services was as a standalone business, it would attract a enterprise value to revenue multiple of 20. Now, the reason I say that AWS would attract a multiple of around 20, we saw there that Twilio had a multiple of somewhere between 17 and 23, and yet Amazon Web Services is growing at more or less the same pace, and yet it is 10 times larger. So it is, it's more stable, it's more secure. So if we were to apply a 20 times multiple to Amazon Web Services on their trailing 12 months net sales, that would provide a valuation of $1.1 trillion, which sounds absurd, but ultimately all I'm doing is taking the revenue of Amazon Web Services and applying what looks to be a market multiple for that type of business. $1.1 trillion. Now, Amazon as a whole is worth currently to the market $1.7 trillion. So not only do you have the e-commerce side of things, but you've also got, for example, Amazon Prime and all of the other divisions that Amazon have, right? So if that valuation there for Amazon Web Services is correct at around $1.1 trillion, you're effectively paying around $600 billion for the remaining business, being the e-commerce side of things, as well as they've got Amazon Prime and all of the other divisions that they operate in. You're paying $600 billion for that. Now, the Amazon business, excluding Amazon Web Services from 2022, is likely to generate revenues of at least $400 billion. So effectively, you're paying a 1.5 times multiple on revenues for that remaining business. Now, that seems incredibly cheap to me. But anyway, that is just a very quick calculation to try and gauge an understanding of the potential value of the segments within Amazon. Anyway, all of that sounds very good and very bullish, and it all sounds very rosy, right? But we can't ignore the fact that their profits have just decreased by 50%. So let's have a look what management actually had to say about that. So we can see here that Andy Jassy, the CEO, said that we've always said that when confronted with the choice between optimizing for short-term profits versus what's best for customers over the long term, we would choose the latter. And you can see that during every phase of this pandemic. In the first several months of COVID-19, Amazonians, and I think that's the first time I've heard that, played an essential role to help people secure the requisite PPE, food and other in-demand items needed, and we worked closely with businesses and governments to leverage AWS to maintain business continuity as they responded to the pandemic. Anyway, all of that is just a bunch of words, but what does that actually mean for the business? So the better part comes here. Customers have appreciated this commitment, which is part of what's driving this past quarter's AWS growth acceleration to over 39% year over year. But it's also driven extraordinary investments across our business to satisfy customer needs. Just one example is that we've nearly doubled the size of our fulfillment network since the pandemic began. In the fourth quarter, we expect to incur several $1 billion of additional costs in our consumer business as we manage through labour supply shortages, increased wage costs, global supply chain issues, and increased freight and shipping costs, all while doing whatever it takes to minimise the impact on customers and selling partners this holiday season. It'll be expensive for us in the short term, but it's the right prioritisation for our customers and partners. So a bit of a mouthful there. But effectively what he's saying is that in the short term, Amazon are willing to take on the additional costs rather than pass those on to the consumers in hope that they will earn their loyalty of these consumers. And in the long term, it will benefit Amazon, right? So rather than pass on loads of additional costs. Now we've seen all of sort of news in the media, right? So there are labour supply shortages, there are supply chain issues, there is a lot of inflation, costs are going up, shipping and freight costs have gone up by something like 10 times since prior to the pandemic. So there is no doubt that businesses are feeling this squeeze. And if Amazon are willing to take on the burden of those costs, and they're clearly able to do so, right? I mean, we'll go onto their balance sheet shortly. In the long term, they're hoping that this will benefit their customer. The good thing about this, right, the thing that I really like about this is that this philosophy is continuing despite the fact that Jeff Bezos, the former CEO and the founder of Amazon, has actually stepped down. So for those of you that are familiar, Jeff Bezos has always said that he always wants to put the customer first, and in doing so, the customer will put Amazon first as well. And it's worked out pretty well for them so far, and I expect that it will continue to work well for them in the future. So what do we take from all this? Well, a lot of the issues that they do sort of name in here, so supply chain shortages, labour shortages, these are all going to be short term. We know that. We expect that wage costs are probably going to stay, or the increase in wage costs are here to stay. But I think the main issues being supply chain issues and labour shortages are all transitory things. And I think that the increased freight and shipping costs going up by a factor of 10, I'd expect those to come down at some point, right, when things start to normalise and the global economy starts to get back to its normal function. So I think that the hit to Amazon is short term. I don't expect that their fundamentals of their business have changed so significantly that all of a sudden their margins have been cut in half. That doesn't seem realistic to me. So I don't think that this would be a concern for the long term, but certainly over the next couple of quarters, it's quite possible that we're going to see some relatively poor results. Certainly not what we're used to from Amazon. And the reason I say that, right, is because we can actually see that their gross margins actually haven't been impacted. I think the gross margins have actually increased ever so slightly, but it's the costs below cost of sales which are hurting Amazon. And usually these are the costs which are slightly or somewhat more fluid, right? And therefore I'd expect that over the long term, these would reduce. Anyway, so we can see that cost of sales as a percentage, or cost of sales was $57 million for the 3 months to 2020 on $96 million of revenue. That was 59%. And then cost of sales was $63 million on $111 billion of revenue. And that was 57%, I believe, as a percentage of revenue. So not 57% gross margins, right? It's 43% gross margins versus 41% gross margins in 2020. Hopefully I've not just confused you there with sort of the reverse of the percentages. Hopefully you get the point. Either way, the point that I'm saying is that the additional costs are coming below cost of sales. So we can see here that their fulfillment costs have gone up quite a lot, right? So they've gone up by, looking at that, probably 30%. Their technology and content costs have gone up by, again, at least 30%. Marketing, again, 30%. So they've seen huge increases in their costs on the costs below cost of sales. So not hitting their gross margins, but it is hitting their operating margins. I think that over the long term, we would expect their costs to normalize once, like we say, all of these transitory issues do go away. So am I trying to say that this was a good quarter for Amazon? No, absolutely not. It was a poor quarter. It's probably one of the worst quarters that they have seen, at least for the last 3 years, which is about as long as I've been looking into the financials of the business. So without a doubt, right, it's not a good quarter, and that's not what I'm saying. But what I am saying is that this quarter is not an indicator or an indication for several bad quarters to come in several years' time to come, right? So maybe the next quarter and the quarter after that, and maybe even going as far as Q3 2022, right? We might start to see depressed margins and poor results. But certainly from 2023 onwards, I find it hard to believe that these margins are going to remain compressed. So all in all, not a good quarter, but it's not an indication of a fundamental change in the business. And then lastly, we take a quick look at their balance sheet. Not that anybody needs any reassurance that they have a pretty solid balance sheet. Anyway, they've got $80 billion of cash on hand. So that's cash and marketable securities, effectively highly liquid assets. And then if we look to their long-term liabilities, their long-term debt, they have $50 billion. And then they also have $64 billion in long-term lease liabilities. Now, I account for lease liabilities as debt. So in any valuation that I would do in Amazon, I'd make sure to include that $64 billion. Now, why do they have such a high amount of lease liabilities? Well, they have a load of warehouses, a load of centers, and they will all be leased. So rather than pay a significant amount of money up front to buy these warehouses and these fulfillment centers outright, they'd rather just lease those, and it usually makes a lot more sense to do so. So in a kind of business like Amazon, you will always have a fairly significant amount of debt, $112 billion or whatever it is in this instance. But again, right, they generate a lot of cash flow, usually, right? Definitely won't ever be an issue. And besides that, they have $80 billion in cash on hand if they ever needed it. So the balance sheet is absolutely solid, as we would expect. So in summary, guys, it's certainly not a good quarter for Amazon. So they missed revenue ever so slightly, but their earnings were absolutely horrible. And that is due to short-term issues, which a lot of other companies have been experiencing, right? So global supply chain issues, labor shortages, so on and so forth. Anyway, I don't believe that the fundamentals of the business have actually changed, but I do think that they are going to continue to experience these issues over the next 2 or 3 quarters. Anyway, that is all for today's video, guys. I hope you found it useful, and until next time, thank you.